let's bring in Ann-Sofie, a local champion from Volvo Tech Cars Group. Did I pronounce it somewhat correctly? Volvo Cars Tech Fund. Corporate, many names. The next one, let's bring on Rick Howe from Speedinvest. Speedinvest is one of our major funds, multi-strategy, 500 million raised in the last one, all seed. Incredible investor. Rick is championing deep tech at that team. Definitely a person to strike up conversations with. Incredibly knowledgeable about everything. Every time I talk to you, Rick, I am amazed. Let's bring on the next one. Crispin, come on in. Corporate venture capitalist for EnBW, or EnBW is how I should say it to be an insider. Am I right? EnBW. But that's not your...
That's not the fun, no.
Exactly. Exactly. Thank you. And then, finally, let's bring on my dear friend Jeppe. He is a Dane, and for that reason also a podcaster. We cannot shut up. He is hosting the CVC podcast of EUVC together with me. Take it away, everyone.
Thank you so much. So super proud to be here today in front of all of you. For your knowledge, I'm a VC operator by training, and have been a CVC investor for Maersk Growth for 5 years. And now I'm with Andreas, a co-host on the CVC podcast on EUVC. So really looking forward to this. One of the things that, and the reason why I am here and what have my knowledge and interest is that the average lifetime of a corporate venture capital entity is 3.7 years long. It is super, super short. So what we will, it doesn't fit the 10-year lifetime of a VC fund, right? So let's broaden the understanding of corporate venturing and what it can do. So what we will dive into here today is we will look a little bit on the investment perspective and how that looks for different entities and how the collaboration between VCs and CVCs go on. So my first question, Ann-Sofie, right? Volvo Cars Tech Funds, that's a little bit more, a strategic approach, like 82% of the other Nordic CVCs, according to a study from Copenhagen Business School, right? So how do you balance the financial and the strategic outcome when you collaborate with the core Volvo cars?
Good.
Not so good.
This one.
We'll try this one.
Let's see. So first of all, I want to say that we've been around for 3.6 times 2 years. So that's a good achievement from the very beginning. We are truly investing in strategic topics. So that has to be relevant for our mother company. Otherwise, we wouldn't do an investment. But obviously, we wouldn't invest in startups or in companies that aren't financially sound. So this is a balance, obviously, from scouting until the investment decision to actually make sure that we both will get the strategic outcome, and for the mother company to make sure that, potentially the company could be a partner going forward. But if it was a truly financial investment, we wouldn't do it.
Okay. And does that tie also into collaboration with the core Volvo?
We try to make investments that are possible to collaborate with, but it's not really the starting. It doesn't have to be a collaboration first, and then we go into investing. So normally those two go somehow together.
Okay, thank you. So maybe moving into a different strategy over with you, Crispin, right? So EnBW, you have an evergreen structure. I think it's the first time that I've met that, also through the CVC podcast that we have done. So how does that impact your scaling of the investments that you do, and how do you balance this short-term versus long-term outcome?
Yeah, first maybe a little thank you for the invitation. It's really great to be here. It's actually my first time in Gothenburg, so that was an omission, so great to be here. So thank you, Jeppe, but also Sophia, Andreas, for the invitation. So, and you just mentioned 3.6 years, yes? So I'm in my year number 17 now of CVC. Actually, it's the second fund, so I feel like a dinosaur, but I'm still alive. So there are some that survive. And so our logic, yes, is sort of a little bit away from the pure strategic. Basically, the reasoning is pretty simple. After a couple of years of CVC, I figured that I do not own a crystal ball. Maybe someone has here a crystal ball, then please speak to me later. But also our strategy department in the big corporation EnBW. EnBW is a German fully integrated utility, so quite large organization. They also don't have a crystal ball. So we are actually there as a tool for them to bridge to sort of really extraordinary entrepreneurs out there. Because what they have figured too is that actually the sort of really pushy entrepreneurs, they are definitely not working for a corporate, and they want to build their own big thing. So they need a tool in order to bridge that. Now, that's the first piece of the puzzle, but then the question is, okay, so how do you actually act with the investors? So then our decision was to really do a SVC standardized as possible. So that's not really innovative. That's basically really taking the standards. So we have a separate legal entity. We have a committed capital. So we have not this risk of some controlling budgets or I don't know what. We are incentivized on the return because this is a financial business model. It has to deliver profits. So this is sort of pretty standard. But the point is that as a CVC, and this is what is involved is the same as with every corporate, if you just deliver the returns, that's even not enough. So you have to somehow also manage to understand the strategy. And the way we have done it, we have basically written down an investment strategy like every VC has. And there we focus sort of the sectors of interest, but pretty broad sectors of interest. And we then have the freedom to operate within these sectors. So there's no deal-by-deal interference whatsoever. But still, we see, of course, the advantage of the corporation. Now, we have built, or we have basically the thought of a real option model. So basically, in the beginning, we have no clue if there will be cooperation or not, and we don't force it. We don't want to force the entrepreneurial teams, because then they don't want us as an investor. We can't force the business units, because they have their agenda, they have their targets. So if we tell them, hey, you should do this and that, it doesn't work. So we said, okay, let's try to understand sort of what is going on in the organization, but at the same time really focus on the startups and the success of the startups, and then let's just open the doors and see what happens. And so actually what we see over all these years now, so this fund is 9 years in, what we see is like around 50% of the startups really work also commercially with the big corporate, which is fine. Nobody's pushing for a certain level here, so that works quite well. Last point, evergreen. I will keep it short. We have decided that the evergreen structure is advantageous because it is easy to tell to the corporate, okay, one time you commit capital, that's it. We will not come back with fund number 2, 3, 4, ask for money, and not showing maybe the DPI that you want. So basically, we have to sort of refinance ourselves out of the growth of the profitable exits. So it means what we distribute, so we draw when we need, we redistribute, but then we can redraw. And this is quite a really great advantage because we can operate in the startups only value-oriented and sometimes even more exit-oriented than pure VCs are doing it because they sort of sometimes stick in for the sort of option value. There might be still something getting better. We don't. We then push for the exit.
Thank you. So Rick, you operate within this sphere, within a lot of CVCs, right? So you are a deep tech investor with Speedinvest. So how do you see the CVCs and how they operate on the cap table, focusing, on their strategies, right? You have a strategic investor on one side and financial on the other. How do you manage that?
I think for us, so firstly, we are a traditional VC fund. So focus on pan-European early stage. We love to be the first institutional round. And being in the industry for roughly 14 years, have invested more than 400 portfolio companies across Europe and UK. I think for me, my own experience is in the last several years, I actually co-invested with lots of corporate investors. I think for deep tech sectors, corporate investors are very important. The first question I normally ask myself, which is what type of CVC you are working with. As you probably can see, there's a slightly different actually between them. And from my experience, I feel there's normally 3 types of CVC. So firstly is the strategic driven CVC. So most of the time, they don't even have a fund structure like VC, and they probably need business unit. They're basically parent companies, a BU, to approve the investment, to support the investment. And even complex, you probably need a startup to be a customer in order to make investment. And secondly is probably a little bit like VC fund. You have a GPLP fund structure, and you probably have one single LP, which is your parent company. And the top priority for them is actually similar like us, financial returns. And lastly, also there's some hybrid structure, which they're looking for both strategic value and also financial returns. I think among all the different CVC, I do feel there are a couple of things they can bring on the, bring the value on the table for me as a VC. Firstly is market validation. I mean, if you secure an investment from a corporate investor, I think you create a very strong credibility for a startup, to raising additional money or also helping them on new business opportunity. And secondly is, to be honest, I have to say, I feel corporate investors are probably more patient than VC investors. They focusing on building a long-term, relationship with the founders to build a really sustainable business model, rather than just chasing for short-term, opportunities. And also thirdly, very clearly is corporate investors have very strong industry expertise and resources, which can help startups on product development, business development as well. But having said that, I mean, I do feel there are also some risks I want to highlight. Is, for example, their process a little bit longer, and decision-making process internally is very complex. But overall, I think that's probably the way how I view, both strategic, financial value, that corporate investor normally bring on.
Good points. So here in the Nordic, 42% of corporates like to co-invest with other corporates. So Rick, do you often see yourself with multiple corporates on the cap table? Yeah. And how does that work, right? Because we have corporates that kind of claim that, okay, now we have invested into this company, now it's ours, right? How do you see that?
Yeah, and like I mentioned a bit earlier, I think for me as a deep tech investor, actually the most important reason I value corporate investor is their, market validation. If I saw they want to invest in the company or appear on the cap table, it definitely showing there's something, validated by themselves. And also, in addition, as you know, the corporate investor can provide lots of help and guidance during the DD process by providing this industry expertise, accessing their internal engineering teams, and also give you lots of insights into the market. I can give you some examples. For example, on the technical knowledge part, even though I'm from technical background, I do my own DD, but still, you can access, the corporate investor has a dedicated, engineering team or technical team in the parent company. They can basically help you to assess, for example, the feasibility, limitation, also the defensibility of technologies. That's something I think brings lots of value. And secondly, definitely on the market side, they can tell you more insights about target market, particular, like, for example, the competitors. They may work with some competitors already. They can tell you, what's exactly the key things that customers are looking for. And definitely, lastly, is, like I mentioned before, is they really know the industry very well. And one thing I think lots of venture capital investors ignore is they also can help you to really assess the product roadmap and also technology roadmap, which actually, personally, I feel is very important for startup to raising the next round, because they can give you very clear direction, what are the milestones that you should to achieve, before the next round. So that's what I view, like having, investors on the cap table from the corporate side. However, like I always want to mention, a little bit unbiased, is my own experience, I still recommend you probably still want to have an independent expert, to assess the deal, to avoid any potential bias, particularly in deep tech, because some of the large corporate, I know they already have their own thinking about certain technology, but may not be totally correct, I have to say. So therefore, I think still you probably want to bring an independent view on certain stuff. But overall, I personally really love to invest with corporate investor, but just with some, cautious on certain stuff.
Yeah. And maybe over you to Crispin. You have been in the game for 17 plus years. It's a long time. So, you have worked with many of the CVCs. Yeah, you need the beer, right? And VCs in your portfolio, right? Could you share a little bit about, the added value that the CVC brings into the startup and, combined with the VC experience also that is around the table?
Yeah, I mean, I think what Rick just said, I would just underwrite here.
Okay, then I'll go over to Ann-Sofie.
That was, okay.
No, go ahead.
That was perfect. Yeah, so I think what is really important, and now, not by chance, but if you work with corporates on the cap table, I think it's good if there's a professional CVC in between, because if you have a corporate directly, it can come to sort of difficult situations. So the CVC can really help there, sort of they understand sort of the corporate world. Just one example, there's always sort of this, oh yeah, there are all these experts, industry experts that you can then discuss and talk to. Yes, but like in our instance, the corporate is a very conservative utility. So they have great experts, but they actually always try to prove what does not work and not to prove what works. This is just in their genes. So this is just what they do. So you have to have a filter that actually says, okay, so now we are educated about all the things that could go wrong. So then we can make up our mind, can the startup actually go through certain of these walls, and which one it should choose maybe. So this is sort of the piece that is, I think, quite important. We love to co-invest with VCs and CVCs. I think it's always good when we are looking and someone is saying, hey, we want to add a CVC, we try to very well understand the setup. And I think it's always also better not to have only one with a big chunk, but maybe two with a smaller one, so that it doesn't get too dominant in a way. And of course, we do know that we have a high responsibility with putting our brand. So we are called EnBW New Ventures by purpose, not by accident. So we want to bring this brand. And of course, the value of this brand is strongest if sort of the customers, the possible customers of the startup also value that and understand it, that, hey, actually, this is pretty cool. That there's a little bit of a stamp. Hey, this is here to stay, and yeah. So these are this
Thanks for that.
How I would qualify.
And Sofie, can I address? How do you see that at Volvo Cars Tech Fund?
So first of all, I think all of us say the same thing. We like a diverse cap table, and we want to have different perspectives to make sure that the startup can, for example, work in several different sectors. So I think that's what we're saying, right? Then we have different perspectives of how we bring value. Yeah. So obviously, I mean, as a CVC, we probably bring most of the value by verifying that this is a product that is worth it to the market and that there is a potential buyer, and also by our name. And we have a couple of examples from our side where we have verified the technology, and which really helps the startup to go to the next financing round because people trust the brand. So it's super important to stand for a certain brand and that people understand what that means. I think that is what a CVC can bring to the table in a concrete way.
Thank you for sharing. So I'm just looking at Andreas and time, and give me a... Time is getting there. Time is getting there. No. So one of the things that we always talk about when VCs and CVCs are in the room is the tension in governance structure. And Sofie, give me a little bit on that. What do you think?
We love to sit together with others in the boardroom. Yeah. So obviously there is a little bit of tension, but I think it's actually good to have different views. We are probably there for the more long term, and if we have a VC who is trying more and more to get financial output, that doesn't necessarily have to be a bad thing. But we need to understand this. So when we are reviewing to invest for a new startup, we are really looking into the cap table because we want to be able to collaborate with those on the cap table. Because we are here. That's super important to say as well. We are obviously here in the boardroom for the company's best. Yeah. That's another responsibility that we have, right?
For sure.
So we need to have, what hat do I bring today?
Yeah. And you should be glad to be on their cap table, right? So it's kind of like...
I'm proud. Yeah.
Please join our portfolio of companies. No, you are part of their company. Crispin, a few words on the governance part.
Yes, I mean, it's always this cooperation for sure. We are minority investor, but we want to have reasonable shares. So we do lead, we do co-lead, we do also follow-on, so just co-investor. So, but we want to have a reasonable share. So a board seat is important to us to really bring the value over. So just observing would be not enough. We have very fast decision processes. So we think we try to be as compliant to the best VCs and also the founder teams as much as we can. Now, what we've seen actually is that sometimes, and it's not the one in the room, sometimes VCs tend to, when in our experience, it's always a bumpy road. When there is problems showing up, they sometimes just say, okay, you know what, it's not worth it. We focus on other top performers. So then the partner is getting, the principal is getting the associate that is sitting on the board. So we've seen that, and we tick a little bit different. So when it's getting bumpy, we try to understand what's the reason. So is it really the execution of the team, or is there some other reason? Being in the market, being in the product, being in the technology. And so this allows us to be a little bit more patient and to maybe see, okay, is there still sort of something to save or what can be changed? And this is what we try to bring in then. But I mean, when we then figure that, A, it doesn't work, then we trigger the exit.
Thank you. So leaving the last remark to all of you, if you are a VC or an angel and how to handle corporates on the cap table, go to Rick. If you are a corporate and want to know how to do a CVC, Ann-Sofie from Volvo here, and Crispin from EnBW in Germany. Thank you, everybody.
Thank you.